Ladies and gentlemen, we're back with another show with TradeStation with David Russell. And this show is going to be another great one. And I just want to say, because there's a special select group of people out there on the TradeStation, might be in the TradeStation TradingView community that have been following this show. And there have been some fantastic concepts, ideas, and insights coming from this show, which we're going to get to because there've been a few big hits since our last show. We're in summer trading. There's so much to discuss. And I'm going to hand the mic over to David here to kick us off. But before I do that, I do want to remind you all that this show is sponsored by TradeStation. TradeStation pursues a singular vision to offer the ultimate online trading platform and services for self-directed traders and investors across the equities, equity index options, futures, and futures options markets. Equities, equities options, and commodity futures products and services are offered by TradeStation Securities Inc., member of NYSE, FINRA, CME, and SIPC. David, let's get into it right away. I want to pass the mic your way because what a move in market since we last spoke, and so many precise moves nailed again and again, basically since the tariff lowdown. So passing it off your way.
Well, great. Well, it's good to see everyone, and thank you, Steph. What's interesting, I think, right now, when we look at the overall market, and we talked to this before, let's take a look at the S&P here, is, we had this time when we talked about sellers getting punished. That was a long time ago, back when the market was trending higher. And we often talked about how we get these tight periods of consolidation with continuation. If you look back in late 23, there's this tight sideways movement with very modest pullbacks. These are way back over a year ago when the Fed first got to the point of getting ready to do that initial cut. And so this tight sideways movement gets resolved to the upside. And we saw a lot of that with very tight pullbacks. Now we jump back to the current time. We see all this intense volatility, deep pullbacks. But what did we see up here? Well, first of all, we did see a tight sort of range right here. And I think this is kind of interesting to see this essentially taking shape, that we essentially see this kind of tight range forming. I mean, it's not as clear as some of the other ones, but it essentially formed kind of around here. Tight sideways movement. Each time it takes a stab down, it basically holds. Look up here, though, in the last, in the month of July, and you basically see that we basically held that. So, I mean, it's interesting to look at the low on July 7th. It was a Monday weekly low. Last week, Wednesday on the 16th, was a weekly low, 62.01 both times. Tight sideways movement. And again, you can kind of see another one of these sideways tight movement patterns forming. It's not glamorous, doesn't have any fancy names, but this tight sideways consolidation is a very meaningful pattern. Make that go away. It's a very meaningful pattern. And it's, again, kind of giving us a sense here that there is just not a lot of selling pressure in the market. When I look at this thing overall, what I would say is that, first of all, I want to tell people Jerome Powell speaks tomorrow morning, and the European Central Bank has a meeting on Thursday. So just remember, those are both in the pre-market for American trading. But, I think when you look at what's happened, like last week, we thought the Fed was going to, we're going to, fire Jerome Powell, and then we're not. Again, this is what happens in a bull market. In a bull market, you catch a cold and you think you have, pneumonia, or you think you have bubonic plague, and it turns out to be a cold. In a bear market, you get a sniffle and you think it's a cold, and it turns out being bubonic plague. I think that's the way to think about it. When you're in a structural bull market, essentially you're in a spot where the scary news resolves in a positive direction, or it disappears and fades, and positive things come out of the woodwork. And I think that's what we're seeing. So last week, for a while, this market crashed because we thought, oh my God, Jerome Powell is going to get fired. Then that just disappeared into the ether. And before we know it, now we have Scott Bessent saying, oh, we have to somehow do a review of the Fed, which is just a big political way of saying that we're not doing anything. It's a big nothing burger, fades away. Also, over the weekend, we see the Chinese exports of rare earth materials to the United States going up 660% in June. What does that tell us? It tells us that the situation between the United States and China is calming. We also see that some of the chip restrictions going away. So again, we start off with this horrible tidal wave of scariness, and then it just kind of fades away into a trickle of who cares, been there, done that. And I think that's where we are. So my view here is that in many ways, when you look at the volatility of the new administration, that this is kind of like Winston Churchill said. It's not the beginning of the end, but it's the end of the beginning. He said that at a certain point in the first, in 1942, when it was when the worst of the German victories were in the rearview mirror and the Allies started to come back, he said this is the end of the beginning. And I think that's where we are now in terms of the uncertainty of the Trump administration. We've gotten past the point when the tariffs that maximized and blew up, the interfering with the Fed that maximized and blew up, and these big kind of potentially institutionally, legally, geopolitically scary macro events. These have now potentially been in a spot when we've seen the worst of them, and now it's a shift back to quote unquote normal. And I think just going back to normal, when it goes away from a state of horror and terror and absolute fear, and it goes back to normal, that in and of itself is an important thing for sentiment. So I think that's kind of where we are right now, and that's why it's been so tight. Sellers get punished, Steph.
Well, David, let me say, awesome intro to today's show. And that is something that I hope, especially if you're a new investor or trader looking to learn more about markets, you should almost rewind and listen to that again, because there's so much there. And specifically, David, if you don't mind, before we go on, your comment about the, in bull markets, you think it's the bubonic plague, but just a cold. In bear markets, you think it's just a cold, but it's the bubonic plague. Could you just walk us through that a little bit more, and even maybe use the chart, just because that is a fantastic concept. And when you're in moments where you think a bear market is hitting, it always feels like the bubonic plague. But these sort of, the market shakes it off, and hey, it was just a cold, now we're back. Being able to identify that or think through that is so important to being an investor or trader, so you don't get scared so quickly because it might just be a cold.
And to me, one of the main things in that is essentially, where do we find support? And the thing is I don't even know the correct term for this, but if we say, how far back is it? So this was like a 2-week pullback. If you look, this is what I love about TradingView. We can go over here and we can do this. We go to this little toolkit and we go to date range. So we can basically look, this is an 8-day pullback. All right, now that's not very much. When you're in a more ugly market, like here, look at where this was. This was now suddenly, when it started getting ugly, we were now talking about, an 83-day pullback, which is almost 3 months. So the thing is when you're in an uptrend, the pullbacks based on their time are not very, long. They go back maybe 2 to 3 weeks. You're hitting the lowest level in 2 weeks, 3 weeks, and you bounce. But then a bear market, when you're in a more of a bear move, this number is much bigger. These arrows are much longer. I think that's the way to think about it. The way to conceptualize this, I think objectively, quantitatively, is how long of a pullback is it? And it's basically, this pullback here was essentially a pullback of, it was a 10-day pullback. So, and this was a pullback of something like probably around 12, 13 days. 12, Anyway, that, I think you get the idea. So the idea is that you don't have to go back very far. It's like sometimes in life it's 5 step forward, 4 step back. In this, it's like 3 steps forward, 1 step back. In a bear market, it's basically 2 steps forward, 5 steps back. So I think that's kind of the way to use the time measurement sometimes as well, in addition to simple to ordinary indicators like MACD or moving averages, or even other kind of trend indicators.
Dave, what's so interesting? Actually, before you delete, you delete those, but I never put that together actually about the tariff sell-off, all the sideways action that occurred into that sell-off. That 83-day, it went 83 days of sideways sharp moves, and then finally the flush out happened. So very unique insight right there about tracking the length of time of sort of the indecision. And that is something, again, for the new traders and investors out there, like, restart this whole segment, watch it again, then watch it again. That's why we do this show, to help everyone. And it's why we have David and TradeStation here. So David, now onto the charts. You mentioned to me before we went live about, you were speaking about silver and rates. I don't know if you want to go there just yet. Maybe you have something else planned, but if so, I want to hear it.
First I want to talk about, we often talk about the big things, the dollar index and the 10-year treasury yield. It is important to me. I want to point the dollar index DXY. Go to a weekly chart here. And, for me, this sell-off, there's a brief noise there. All right. So basically, this can be viewed as an Elliott wave continuation when you have your 5 legs down in one way. So this is now a completed move potentially. What's interesting to me is look at the dollar index here, coming off that low and holding a 50% retracement of that bounce. It didn't do that in these other times. And if you look at the other kind of bounces, it did not do the 50% retracement. It came off this low and it quickly went up and it just immediately just blew through that. So I think, that this is something that this is the beginning. This could be the beginning in many ways. I don't want to call it like a significant rally in the dollar because, that's something that doesn't necessarily make sense. However, if the dollar stabilizes here for a quarter or two or a few months, that could actually be consistent with a return to American equities and to good old-fashioned buy the NASDAQ growth S&P sort of thing, and some weakness in some of the things we've seen, like potentially European stocks. I'm not super sure of it, but I want to just mention here that this is giving some signs here of inching higher. And I think when we look at, Jerome Powell kind of the Fed essentially kind of, looking like it's in solid shape, all the challenges to its independence and all that seem to be more or less fading. The ECB is coming this week. I'm not going to say overall that, I'm bullish on the dollar or something like that, but I think we have to realize here there is the potential for the dollar here to potentially move back to the upside. And so I think people who are sitting around in gold thinking that they're safe forever, it can never go down. I mean, gold is also here just drifting, and I'm not going to try and say anything bearish about it. I'm just saying that I think we have to realize is that there are some signs that a turn could be coming. And, I think one of the things with turns and reversals in the market is, you have to wait for confirmation. I don't know if we really have confirmation yet, but I want to just point that out. I think we're seeing that in the dollar, and I would say that a rebound in the dollar would not necessarily be bearish for stocks. If anything, it could represent a return to what we had before, American exceptionalism, buy the NASDAQ and all that stuff. And I would just say that there's a lot of money, a lot of crowded money sitting in the weak dollar trades right now that could turn around, and it could create a rush back to the S&P. So I want to just point that out. Now, another thing is the 10-year Treasury yield, because the 10-year Treasury yield here essentially is pretty much completely neutral. So I think that it's interesting to just kind of see where we are, where we've made these higher lows, but then we really are not clearly, clearing it to the upside here. So from my view here, again, I'm not saying I see anything clear in these. Both of these charts to me are kind of without trend at all. They're kind of neutral. But I think it's important to realize that if they reverse the other way where they're going, some of the things that we've seen recently, like housing stocks being weak and things like that, might actually have some surprising reversals to the upside. So to me, what I'm almost saying here is I don't want to be predictive of anything. I want to at least be open to the possibility, because I see some potential things starting to set up of rates moving lower, of small caps maybe breaking out, of housing stocks maybe coming back, of real estate stocks maybe coming back, and of the weak dollar trades potentially stalling and maybe seeing some profit taking. So I think we have to at least recognize that potential now could be taking shape. I have some other things I want to talk about, but go ahead if you want to ask about that.
At that macro level, there's so much to review there. And I think what's cool as well about that is, we get quite a few people interested in gold, in the dollar, watching the show. And as you know, we often focus on US equity markets. So that's a very nice high-level overview for that segment of the audience. So I love that you just did that review, especially with the dollar. And I have to ask on that dollar chart as well, are you using some Elliott wave there? And if so, that's pretty neat. We have a large Elliott wave user base watching this show as well. So it's nice to see Elliott wave 2 on that big of a time frame. So it looks like you start this dollar move from the start of 2025. And here we are, sort of like in that fifth wave. Maybe now it's time. The bearishness has been washed out. It's time for like a new regime of sorts. And yeah, the dollar getting stronger. That I'm still trying to process about how that could influence markets. I always thought a weak dollar was sometimes very bullish for specific assets. A strong dollar. What are you thinking there?
Well, it's different kinds of strong dollars. If you have like this weak dollar was bad for stocks. I mean, the market was crashing, the dollar is moving lower. So I think it's not in markets. Nothing is always true, right? And I think it's important to realize. And I always say that there's like these correlations are not always true. I mean, I remember when Enron blew up and utility stocks were anything but a safe haven at that time. So I think the thing is that, healthcare has not been a safe haven, for example. So the thing is that these correlations and kind of, common sayings, these cliches, these might not always play out. And what I would say here is that a lot of this weakness in the dollar was sell America, capital flight sort of thing. And that going away could actually say, you know what, if you're some international investor and you've spent the last 3 to 5 months buying European stocks, and now you turn around and you look at the dollar and you maybe have a position that is overly net bearish on the dollar, people can be like, I need to straighten that out. I need to change some positioning. And as that happens, there's a crowded negativity in the euro, and this could cause a squeeze. I've seen this happen many times when a currency goes one way. I mean, currencies are not stocks, and they can trend, but they often revert, and they don't necessarily just go one way for a very long time. So I think it's just important to realize that we have had a lot of news recently that has been, strong employment, strong retail sales, the Fed holding off on rate cuts. And I'll also mention that the late 90s, believe it or not, was not a dovish time. The Fed was, cut rates in 96 or so, and then they stopped. So I think, this in many ways could have a situation when you're in a true tech equity boom. It should not be fueled by rate cuts. That's kind of a sugar high way to get to new highs. If you're growing on true earnings, on true economic growth, on true productivity gains, you don't need rate cuts. And I think the nice thing is you save that dry powder for a recession, and then you cut, and then you have a different kind of rally. So from my view here, I think that we're in a spot where what can happen is the short-term rates can stay where they are, but then the longer-term rates can come down and the dollar can increase somewhat. And in that period, we could see a refocus on American stocks and weakness in the global. I just want to mention that. I don't want to place too big of a thing on it, but I do see that there is, when you look at what's been happening in gold and some other things, there are some signs here of this stalling. I mean, if you actually look in the last month or two, global stocks are underperforming after a period of significant outperformance. So the question is just, what happens if we go back to normal, so to speak? And I'm just pointing out there are some signs of that starting. And I just want to emphasize that because, to me, I think we just have to be careful that we've had the first half. We're now in the second half. The second half could be back to normal. American consumers, America housing, American tech, American financials, and globally, I mean, that is kind of something that can become a major focus. People can kind of say, they can return to that traditional sort of strong America trade that everyone, basically wrote off a month or two ago. We might just go back to the way things were. So that's kind of my thought. And I think this is a spot here where I don't want to be saying that this is a prediction or anything like that, but we have to entertain it because, Mark Douglas says, you have to be open to the now flow of opportunities. And if the opportunities present us the way I'm describing it as a potential, and we get confirmation of that, then I think we have to we have to be careful just saying, I'm just going to buy gold. I'm just going to stick with this global trade because things might reverse. And that's just how I see it. So
that Mark Douglas quote was fantastic. Every time we do this show, we have some gem quotes coming from great investors or traders or just insights. So I like that you just dropped that. Now, back to the dollar, or sorry, currencies versus stocks as well. I thought that was a good insight because I see it all the time too. If I look at a chart, say of euro, US dollar, and then look at a chart of Apple, you rarely ever see currencies trending like that. So it is such an interesting distinction there, the way the assets can trend. That's totally, it's just kind of an off-market comment. Just I love the educational aspect of our shows often. And going back now to what you were showcasing as well with, I believe, you were mentioning Homebuilders. You showed gold, silver. So what else is there for us to start charting and watching until our next show a month from now?
Well, I think silver. I mean, the funny thing is that silver didn't do well when the dollar was crashing.
God.
And so silver is a weird thing because it's industrial. So the thing is, the first half of the year, the theme was global crisis, global recession, and silver is not going to do well necessarily in that environment. Silver has that industrial application. So now we have silver breaking out. At the same time, gold is kind of, in its range of where it was. So if we look at the gold silver ratio, I mean, it really reached a historic extreme, back here in, wait a second. So this was during COVID, but if you look here, I mean, this was a peak of the ratio of gold versus silver. So we had this kind of extreme sort of level. Where was that? Let's go back to a weekly chart here. Basically that was in April, in that when things were still kind of chaotic and frightening, and we've seen basically the gold underperforming silver ever since late April. So that's actually a period of time now when we have something of a trend established. So even with gold going higher, we now have a breakout in silver. And so from my perspective here, we look at this in the weekly chart. Again, we can do the whole thing we showed earlier about counting time frames. Well, silver now, hey, this is making now, its highest level in, over a decade. I mean, where were you in September of 2011? I mean, that was 14.
Wow.
We're back to almost a 14-year high right now on silver. So from my view, that's kind of the way to think about it is, gold is making kind of, maybe 2-week highs or something on the daily chart. It's back at its highest level since mid-June, but silver is back to its highest level, in over 12 years. So I think that's kind of, it's on pace for its highest daily close. So from my view here, it's kind of counterintuitive, but silver could rally with the dollar inching higher. And I don't want to like overplay this dollar thing. I'm just saying that if we get to a spot where certain trends that have been in place stall, then we can see new trends come to life, and some of those trends, could be surprising. And the other thing is that, gold is a safe haven, and people were buying gold because they thought, oh, America's, let's de-dollarize, and that entire narrative. And if that just stalls for a quarter or two, gold could struggle in that environment. And if we get through that, so I just want to emphasize that. I just want to just be clear that you always have to be careful with a crowded trade in the market. And I think gold's a very crowded trade here. But silver is a new one that's breaking out. Now, we had talked at one point about platinum. I think that I haven't looked at that one recently. See, that's just kind of consolidating. But again, it's up to high, it's still, it's above its levels from mid-June when gold is still below its levels from mid-June. So platinum, silver, these are the industrial sort of areas. These are more consistent with an economic growth environment with a sort of risk on. So, I think that's kind of what's interesting to me here. And I think that when we look at some of the silver names like Wheaton, WPM, we did a TradingView idea on this not terribly long ago. Look on this chart, WPM, Wheaton Precious Metals. Again, I think that a lot of these silver miners are now in a spot. I think PAAS is another one, Pan American Silver, HL, Hecla. A lot of this one is not, I mean, this is also, here you have a name that's basically just gone nowhere. And I don't know much about this stock, but I would think right now when people start looking at the silver miners and they start looking through, the main one I was kind of focused on was Wheaton Precious Metals and Pan American Silver. These names here have been essentially, look how this one is consolidating above this high here, from April. So PAAS and WPM, these are, associated with silver. So to me, this is really just the way to think about it here is that these have not really fully expressed that. And this is maybe where we see the strength popping up that doesn't get that much attention. I mean, the honest truth is a lot of these silver and precious metal names have been abandoned for, since the year 2011. I mean, people have not really traded them. So these can now be rediscovered. And that's kind of where I'm looking for some, potential things. But I got to tell you, the other one, which I just look at
David,
the Hang Seng.
David,
I'm sorry.
David, before we go on, is it silver related or is this okay? Before we go on to the next topic,
yeah,
I'd love to just chat about silver a little bit more there because that was, I mean, not only did we get the review of the metal itself, we also saw some individual names. So, I thought it was funny too because you said, where were you in 2011? Actually, that's a fun exercise for people when they find charts like this, which is how much has the world changed since 2011? And maybe just show us this silver chart in more detail. That's fascinating. So gold's at this all-time high. It's been there now. It broke through that triple top. Silver has not taken out its all-time high from even 2011. Can you walk us through just some of the things you're seeing here? Because that you don't see charts like this anymore.
Well, I think that there are, to me, there's all kinds of conspiracies about pricing in silver. I mean, to me, where it's
By the
interesting
way, I've
about
heard
this,
some of them by them
yeah,
trying to suppress it and things like that. I've heard
I'm
those.
not, and I'm not a judge of any of that. I just look at price action, and I don't really know. I would say that we were basically in a bear market for commodities. It started in 2011, 2012. You see it not just in silver, you see it in Freeport Macro, you see it in all of these stocks. You look at some BHP Billiton, Rio, these stocks have been dead for like a long time. And so I think it's important to realize is that this is a commodity. Gold is not exactly a commodity. It's like this other thing because it's like, it's not used, it's like a store value, it's a central bank asset. But then you look at stuff like, copper and iron ore and metal, the industrial stuff. It's a different thing than what gold is. I mean, there's a relationship, but they're not exactly the same thing. So the thing here is that we have been seeing a strength in things like steel, in materials. All these things have been showing relative strength recently. So I think you have to put silver in that context. Complaining about the suppression of silver's price down here when all the industrial metals were weak, maybe it was a conspiracy, maybe it was just the way price action works. But I think now we're in a spot where this chart is, you can actually see that the uptrend is accelerating. You can see the actual trend here. If we look at this, I mean, it's getting steeper. So from my perspective, this is what something looks like when it's getting ready for a breakout. And the other thing that's interesting is look where silver made its big move back here. It really started running in like November of 2005. Well, look at where gold started running. Gold started running before silver. So if you go back to November, it really broke out. Gold broke out here in you can see it. Well, actually, no, these were around the same time. I have to go back and look. Now, you're asking me about history. There was actually a moment here where you can see here that gold really broke out and silver followed it. And I'd have to go back now and do a lot of this. But the key thing is that silver is like an altcoin kind of, and platinum is like an altcoin. And the thing is that once the initial underlying asset moves, then these other things follow. And I would just say here that now that, it's like Bitcoin will rally and then it'll just sit and stagger and then all the altcoins will catch up. Well, look what gold's doing now. It's rally and it's staggering and floating. And now platinum and silver are catching up. That's, I think, a lot of you guys on this probably trade crypto. So I think it's a good way to think about it.
I have to say, David, on that note, the altcoin comment is really great because I've heard people say before that gold is, the original Bitcoin. And then I guess if you think about that, silver is the altcoin, it's like the Ethereum, and then there's platinum. And the platinum run-up has been interesting. And by the way, for those who watch this video series, and some of you have reached out saying, you've noticed some great insights, some great commentary. The platinum comment has come up multiple times throughout this year. And David did show that chart earlier, and it's just like, you got to follow this show, everybody. There's something here each month we do this. So with that being said, thanks for the walkthrough through silver there. And I also find it interesting that silver has lagged gold so much despite being sort of this still kind of a precious metal. But I know what you're saying. It's also an industrial. Now, I did interrupt you when you're about to go into another market, and we're okay to proceed now. That was just a great silver chat. I find that fascinating.
Well, I'm looking at China now because, I mean, the Chinese, there's been some relative strength recently in the Chinese names. And I mean, if we're at a spot here, I mean, China has been like really emerging as a strong name in a lot of sort of, they've been doing all sorts of stuff with AI and also a lot of things with nuclear energy. And there's a lot of interesting things happening in China, quantum computing. And when you go beyond, China is now running entire factories on robotics and stuff. And they also have a government now that went from being, kind of extreme communist anti-business to being now pro-business. My perspective is want to look because, the Hang Seng and some of the different Chinese assets look to be at a spot where they are potentially starting to break out. We did Alibaba recently as a TradingView idea. And I want to just, look at some of these things where it had this big rally early in the year and it has just sat and kind of consolidated since, but it has this downtrend. So I just think we have to realize here, from my view, there is the potential here. I think for some of these Chinese names to kind of come to life as people realize, what, the worst of this, like I said, it's the end of the beginning. So if the worst of these trade war things are over, this, it rallied, it held, There's also, if you look at the moving averages here, I don't have it on this chart, but I'm pretty sure the 200-day moving average is coming up on Alibaba. So from my view here, I think we could also see some strength in the Chinese names. And so I think that that's another sort of unexpected thing. I mean, most people probably think that's kind of probably unexpected, but it's one of the reasons why it's kind of standing out to me is that some of the actual news flow and the actual price action now kind of maybe suggests that the worst case is now priced in for China. And if we get to that spot when we have some kind of ending of these trade restrictions and that news recently about the rare earths, China increasing its supply of rare earths, it could show a kind of calming of these tensions that have existed. And if that is the case, these Chinese stocks, if you look at the long term Hang Seng, and you look at, there are various ETFs that track these as well. I mean, this is something that has been down for a long time and not really done very much. And so people might actually look for this to be an area with some combination of both growth and value. And I think it should be on our radar, because when you have these tight kind of consolidation, when people, I want to pull back, and you don't get the pullback, it just inches higher. I mean, this chart to me doesn't really look very bearish on the week, on the daily. I think when we look at these different patterns here, these higher lows, we look at the fact that it's kind of squeezing through that high. I mean, nothing here looks very bearish to me on this chart. And I think that a lot of people aren't thinking about this yet, but it's starting to pop up in the price action.
Well, on that note too, I was looking into Alibaba while you were showing us the chart and walking us through that. And I'm always interested to see its PE ratio, which is 16. And you just don't see tech companies of that size anymore with a PE ratio of 16. Not that that means, right? You were actually saying something very important in the show about how these cliches, they're not always, going to be true in markets. Like a low PE ratio doesn't mean it's a buy or it's undervalued. Who knows? Maybe there's something else. But I just find it interesting that it does have a PE ratio of 16. And then you show us those charts that's interesting. Like, you don't see those 16 PE ratios in high growth tech at that market cap very often. So maybe that's where my mind is sort of trending, you could say. And this Hang Seng index is very interesting. So is this, but of course, this would be something where you probably want to isolate maybe to a few names in the region, I suppose, rather than playing, because there's not really many ways to trade the index of sorts. So, how would you maybe think about it, I suppose, if you wanted to get exposure, find a trade to this market?
Well, there are some ETFs that I'm not able to talk about, but they do exist, and they're not that hard to find, that follow this. So I think that from an overall view, there are a lot of Chinese names that at this moment, I'm not sure which ones to talk about. We did a TradingView idea on Alibaba. In fact, I was looking at WB.
And that's a good
reminder. I don't know what it was. I don't remember now. I haven't looked at the individual names well enough aside from Alibaba. But the key thing is the Hang Seng itself seems to be doing this. There are ETFs that follow it. And from my perspective here, there's a reason why it trades for 16 times earnings. It's because people have been focused on the political risk. And if the political risk now eases and we go back to quote unquote normal, then you suddenly realize that you have a Chinese government that is actually pro-business. This is not 2021 when they trashed the stock market. This is now a Chinese economy that wants to be pro-business. And they also have had all kinds of AI breakthroughs and all kinds of technological breakthroughs. And there's a possibility of them doing more stimulus later in the year. So I think when you look at it right now, China is in that spot where I just think it's interesting that this is kind of, to me, what something looks like when it breaks out, and you look back later and you're like, how on earth did I miss that? I've seen these sort of things before. There are simply no sellers, and people are buying it at higher lows. This is a textbook sort of example of what something looks like when there are no sellers and just demand exceeds supply. This is textbook.
So we've got now the precious metals trade. We've got the China trade. You did the introduction. We went through rates. You did mention Homebuilders too, and I haven't forgotten about that. I don't know if you have any charts prepared for Homebuilders, but is there another area in the market you're looking at? And also, I'd love to discuss before we get into this other area as well, sort of, a company like Coinbase, because since we chatted last month, I was looking, I think the exact numbers, it's up 60% since our last chat. Now, this is not just, 60% on a company, not many people. This is Coinbase, $100 billion market cap, 60% move since our last chat. Look at the chart right here. Maybe if you want to catch us up on this and any other markets you're watching at this time.
Well, I think this is one where it had the good news the expected good news, which did come out, or the potential good news of this thing getting passed in Congress. But to me, it was more at the pattern recognition. This looked exactly like Micron. If you look at Micron, it had this chart. I think this is the same chart we used, so you can see the markups we had. It had this tight consolidation with the 21-day catching up. So you had this rally, tight consolidation, breakout, and that's exactly what Coinbase had. So we had discussed it based on that same sort of chart pattern. And I think this is something where, again, what do we see? We see basically tightness. We see, the short-term trend being confirmed. It also consolidates above the 200-day. So from my perspective, this is something now that there's a good lesson for us. And I'm not seeing this exact pattern the same way I was before. But this was, to me, the classic thing was that we had seen essentially the break of the downtrend and the consolidation of the 200-day. This is, to me, something when it's in the middle, when it's in kind of like if you could think about it as maybe a three-stage move or something. You have like the first move, the second move, and then the third move. There's ways to think about it that I haven't actually charted out here. But the fact is that trends have stages, and sometimes you miss that first stage, but then sometimes the very best parts of the move come later. The other one we looked at was NAK, which was a kind of unusual. We had talked about it back here, and it went up significantly. It's a very volatile minerals name, but again, we do stuff on TradeStation when we simply look for things that are following their 21-day exponential moving average and making new highs. I have a scan that basically says, find me stocks that are touching the 21-day exponential that recently made a 52-week high. And I have a way to scan for that on TradeStation. And basically, that's what this was. It was making new highs. It was near the 21-day exponential. I don't remember exactly when we spoke. It was somewhere in here. And then it just continued. So this is, something else that I think is, we're seeing both of these I found the same way, which was that it was near the 21-day exponential. Well, in this case, it had not made a new high, but it was near the 21-day exponential. So I was looking for stocks that basically were near the 21-day exponential. And I think I also said the 8-day was above the 21-day. I can't remember. I do a lot of scans, and then when I find results, I write them down. But those are two examples. And, right now it's so that's how I found those. And but I am finding another one. We talk about rates. I want to just jump over to this thing, if you don't mind, with utilities, because these broke out to a new all-time weekly high. Now, one of the patterns we used to talk about, Steph, was when something closes at a new weekly all-time high to look for continuation. And if you look at, like, for example, the first following the the whole tariff drama, the first of the sectors to close at a new all-time weekly high was actually industrials back here at the beginning of June. New record weekly closing high, 2 weeks of digestion and continuation. We also did a TradingView idea on tech. It also went up at one point. I can't remember where it was, but it basically broke out on the weekly and extended. So it's interesting now to see utilities breaking out and potentially holding here. This is an all-time high for XLU. Now remember, utilities had this big rally because AI was going to drive demand for electricity, and that's what we're getting. So here we are. What happens, though, if rates have peaked? Again, I think that's the important thing to realize here is that these are, in many ways, the inverse of the 10-year Treasury. So if Treasury yields move lower, that's something that gives people more comfort holding them. And on top of that, they also have this growth aspect to them, this secular growth because of data centers and AI. So for me, as strange as it might sound, I think there's the potential for these to extend. Now, I'm not too sure about these individual names, but I will mention CEG was actually at one moment in time, I think last year, it was one of the best performers in the S&P. I mean, Constellation Energy more than doubled in 2024. Another one was VST. Basically had this incredible run in 2024 based on data centers. It went from $38 to something like $160. This is a utility stock. So, I mean, that's pretty crazy. Now, not to say necessarily these are exactly the names, but it kind of shows that in the utility space, this focus on nuclear energy has been a big story. So this TLN last week, I don't even know what this company is very much about it. It's not even in the S&P, but they basically, it's a utility stock that acquired some generation capacity, and it kind of put the attention back on utilities, data centers, that whole electricity trade. So I think we have to realize here is that this might be a name people might want to look at, breaking out to a new all-time high. I don't know much about it, TLN, but I think right now this is the beginning maybe of a breakout in utilities. And as boring as that might be, it is with the market. Mark Douglas, this is the now flow of opportunities that the market might be giving us. And that would also be consistent with rates peaking. And then now we can turn to the other stuff, which is things like home builders and consumer.
Well, the theme of this show is the now flow of opportunity. And also I want to add to that as well, the Coinbase and Micron chart, because that's where we started. And I think just want to make sure the viewers are aware of this. Those drawings and indicators on those charts were pretty much unchanged since we last spoke, right?
Yeah, I don't think I've used the chart.
Amazing.
Keep this chart for us.
That is fantastic. So if you missed that show, go back and check it out, or just look at the charts here. These are the exact drawings that we had on the chart and discussion, and look at the move after that. That box, especially that you had on Coinbase and even Micron. Actually, it's very interesting, the parallel between Coinbase and Micron with that box you have there. I mean, almost perfectly. So just want to point that out so everyone's aware. And then we'll have to do the same rather soon for these other symbols, because let's track them, see how the performance is going. And now you just mentioned home builders and consumer as well. I'd love to get into that and what you're seeing.
I would briefly just mention that for people looking to sell credit spreads, they might look at Micron here, because it's trying to stabilize its old high. I don't know much more about Micron right now. This is one of these names that it's a crazy name, because then suddenly some analyst note comes out and it moves, but it is an interesting pullback. Now, getting to the home builders, I want to start off by the XLY, the consumer discretionaries here, because look at how this thing, it's very interesting to me to look at things. It's the same thing of the reference of the meaning of time. And basically what we have here is the January low. If you look at the S&P 500, it cleared its January low. It was this level right around 57.80. It cleared that level in early May. And basically its respective level on its chart was right here. And it got above, and then it held and continued to the upside. XLY, the consumer discretionary ETF, is just now breaking above that. And I think that's kind of interesting. Now, Tesla is a huge part of that story. Actually, let me look at Tesla on the daily chart over here, because Tesla now has essentially the 50-day, look at how close these moving averages are. Tesla's earnings are on Wednesday afternoon. And, there's a company that is, they had some good news recently with some good sales in China coming out and some other things like that. So when we look at Tesla here, this is also a stock where does the news get worse from here? Does Elon Musk go back into the government and start, picking fights with the president again? Or does he go back to being a tech executive who basically gets people excited about, robots and stuff and self-driving cars? I think that's a risk in Tesla here, is that maybe it's a risk to the upside. And so I look at Tesla here. I mean, this is something that's very tight, with earnings coming up, with some potentially good news, the potential for all the worst of the news now being priced in. So I think we want to keep an eye on this and what this could mean for the XLY, because Tesla is the number 2 holding in XLY after Amazon. So XLY here, the consumer discretionary to me is kind of interesting and maybe breaking out. Now, when I look at, I'm just going to mention a few of these housing names, because some of them are kind of obscure, but I just saw this when I was looking at, we did a TradingView idea on Zillow, which is Z. But if you look also at another company that's similar called Compass, COMP. Now this guy, the CEO of this company, goes on CNBC a lot, so he gets some publicity. What's interesting is this is a real estate, also it's a real estate like brokerage, Compass. I mean, I've seen them around, they do, there's like Coldwell Banker or anything like that. Anyway, for some reason, I mean, this is just an interesting sort of, there's only 2 names, like there's this and Zillow, and there's not a lot of these names. The point is that here's something that essentially, it has this gap from back here, but housing, if rates start to inch lower, there could be very significant activity. There's a lot of people who need to list houses and a lot of people who want to buy houses. And we might argue all day about pricing and everything else. But at the end of the day, there has been there's been a very dormant market. And there's probably a lot of people who need to do things in terms of housing. And when the market starts moving, these sort of names that do real estate, basically just listings and real estate agents, the realtor companies, this could be in a sweet spot. And I want to just point out this one, COMP and Zillow. Now, there's been some other crazy names that these are not very well known, but Open Door and OPAD. These were basically tech stocks that are involved in housing. They're involved in things like flipping houses and stuff. But there has been a certain amount of activity in the let me go to this daily chart now. There has been a certain amount of activity in things involving housing. And then if we look overall, this is the Philadelphia housing index. It held this level back here, went all the way back to the high from 2023. So again, I just want to point this out as if we do see that kind of shift with rates and things, it could turn into something here that is interesting. And I want to just kind of put that out there because this has pulled back so significantly. And, people probably have kind of left it for dead. I don't have really strong feelings about housing, but I also look at them where it's like a lot of bad news is priced in. And if rates do move lower and we just go back to something if we go from being terrible to bad, then these names are in a spot where people might see opportunity in them, especially with the market at all-time highs and housing stocks way below their highs. So I want to just mention that in with their relationship to both rates and the consumer discretionaries.
That was a very interesting walkthrough because I heard some names I haven't heard in a very long time, which is, I feel like, something to take note of when you're looking into markets, researching markets. Open Door is a classic one. I've seen that company sort of, it went through that 2021 boom, I want to say. Then it really got hit hard. It crashed. People, I'm on social media quite a bit. People are making, kind of making fun of its journey. And now you pulled up that chart and I saw that it's I don't know, it just recently spiked. So I find that to be so interesting that maybe there's something going on in the housing market. And then to your comment about lowering rates, anecdotally, I do know I am aware of just say people in my network who are waiting for rates to go down actually before listing their home. And I think I even saw that home listings are historically low at the moment, which is pretty, eye-opening. So I don't know. That's something. I mean, that's a mega trend if someone can figure that out. Like, how soon could that take off? So very insightful. Not something I've considered actually for 6 to 12 months.
And it will be the 10-year treasury yield that is the trigger. So those are some. I also want to mention very quickly is that Ford Motor. This is an interesting sort of pullback. Now, again, this is a consumer discretionary. We have to remember consumer discretionary is an interesting sector. It's got Tesla, it's got Amazon, it's got Homebuilders, it's got automakers, and it also has companies like cruise lines and hotels. So it has this big mix of things and retailers. So, I mean, to me, Ford Motor here rallied on some good numbers, and then it kind of pulled back here. And I just want to point out, I'm thinking about doing a TradingView idea on this. But here's a weekly. This is a weekly close. This is a weekly high back here. It was somewhere around here. There's a weekly high. Maybe I can't remember, but somewhere in this range, kind of between 11:30 and 11:40. There's somewhere around 11:30 to 40. There's a weekly, but you can basically see all the way across here that you have some levels, and there's a volatile name, so pulled back under that. But again, if rates ease, if we don't have a recession and everything else. Does Ford Motor really stay down here? Or does it go up and try and fill this gap toward 13 and a half? So I think right here, there's another one that's kind of interesting. I'm just seeing a lot of these names. Another one that has this, I mean, this is almost one that you want to put on the wall, put it in the Louvre or something. I mean, this to me is a textbook sort of pullback. Look at this. This is AutoNation, AN. Again, not an actively traded name, but there's a lot of things on this chart people might see. This is another one that, I think the scan for this one, it made a high and it pulled back. I just look for stocks. I say, show me stocks that made a high in the last month that that are down in the last 2 weeks. It's a real simple scan, but it consistently turns up names like this. So AN, that's another one. And then, TJX, we actually did a bearish idea some time ago when it was up here, and it did kind of ease lower. But now look what we have in TJX. We have it holding this 120 level. I mean, this is an expensive, boring kind of name, but it is also, it is in an uptrend. So a lot of these names also, Marriott, VICI, which does casino properties. A lot of these names have been trying to fight higher. And let's see if they manage to kind of hold these levels here. You can see they have some recent highs. If they build support at the top of these recent ranges, both of them kind of have these ranges in here. I'm looking for these to see if they can kind of, potentially step up, because if consumer discretionary wants to come to life, these are the sort of names that might benefit from it.
Well, David, let me also say on that, you've mentioned the aspect of TradingView ideas. And I do want to comment, because I think it's important, especially as we near the end of the show, that David is the man behind the TradeStation account on TradingView. So you get dual access through this live walkthrough available to, everyone in the world, anywhere. You can come watch this show. David from TradeStation providing his insights, and he's providing all of this research as well. You can see it right here on the screen in front of you. And this is why I think if you can combine this chat with these ideas, you're getting a combination of written work, charts and insights, plus our now live breakdown of what's going on. Hard to beat that. You're not really going to get that anywhere else. It's not on TV at the moment. It's really just this show on TradingView with TradeStation. So I do want to make sure people know, go check out the ideas there, follow the account, get active, see what's happening there, because you're going to see a lot of this as well written down. David, with the last few minutes of the show, anything that you want to end on or, take us home on?
Very briefly, real estate is not normally something that's very interesting for a lot of people. Real estate investment trusts, not home builders. It's a different industry, XLRE. But this is forming a very tight sort of pattern here as well. And I think people might actually see something about this if rates do actually move lower. This could be setting up for potential breakout. But one name in particular that stands out to me is American Tower, AMT. AI, it's interesting, wireless towers have not, yet people have not yet said that they're going to benefit from AI, but this could be something people actually see as an opportunity. So that's one thing I wanted to mention. AMT, there's also SBAC and CCI. They're very similar, but they're all in these kind of tight ranges. And these might be at the beginnings of a bottoming period, especially if rates move lower. Then the other thing is more to the downside is energy just continues to look very feeble. Has this potential here. I have another chart where I have this marked up better, but basically the potential for a bearish breakdown and it's a bearish flag, and then we have these lower highs across here essentially. So from my view here, we have a series of lower highs and the potential of a bear flag here, the XLE. For energy, OPEC is just gonna they're expected to just keep producing more oil, and there's as long as there's no geopolitical risk, that's one thing that's out there. But if there isn't serious like war in the Middle East, at some point in time, there's going to be a point here where, energy, I think they're expected to increase production in August and September, according to Reuters. And if things don't really pan out in a bad way, geopolitically, there could be a spot here when energy kind of has a big breakdown like it did way back, a decade ago. And I'm not going to get into all that now. You can go look on your own charts. But the key thing is that I am watching here. And the other thing I'll just say is if energy does break to the downside, that's going to be one more thing that can help interest rates move lower. So.
Well, nice way to end it. And that will be a good segue into next month's show. So everyone, make sure you're subscribed. Make sure you're following TradeStation. We will kick off next month's show potentially with this, looking at oil and where we've gone and how that's influencing markets. But with that, thank you, everyone for joining this month's show. And of course, be sure, once again, that you're following along so that you get updates, charts, and more, both from TradeStation and TradingView. And we will see you next month, and we'll let you know when we're going live. Thank you so much for watching. And David, great to have you as always.
Thank you, Steph. Take care.